Yeah, I was thinking about
Dan's
it.
here.
Oh, live.
Dan, oh, David Phillip is here as well. Amazing. Awesome.
Are you seeing
Very
people?
cool. I'm seeing it. If you look under the comments, you can see the people that are joining us.
Nice.
Nice. Hi, David.
Check live on LinkedIn.
Welcome, Dan.
So let us know where you're joining from and which organizations you're representing. Okay, we know Dan's from Equidam. Hi, Dan. You're part of the fam. So nice to have
What's
you.
the one-liner on Equidam, Lisa?
So they're our valuations partner. So they basically like provide the back end technology that supports our valuations analyst doing her job.
Cool.
So they're the like database and maths, and then we've got the corporate finance analyst that then like oversees it. Oh look, we've got a fan, Marvin. Yeah.
Marvin's a fan. Wow. Is this
Marvin's
streaming on your LinkedIn, Marvin?
Unmute yourself. Unmute
You're on
yourself.
Yeah, it's on LinkedIn.
In the group. Wait, where's the mute button?
Yeah, my bad. Yeah, I think that's the connection to LinkedIn. So Dan, Nicholas, a couple of people, companies in here.
No, Dan's here because him and I have been chatting about this, and we've been sending each other like comments and stuff. Dan's not here because of you. Dan's here because of me. Okay, you're not the coolest kid, Marvin.
I just chased Dan for this like fictitious co-marketing thing. He's been here about for months to do that. So probably that. I'm gonna actually make it.
Nadine from Nigeria representing Sirius X Energy. Cool.
Nice.
Someone from Atlanta.
Oh, must be early there.
Yeah.
Marvin, is so the money like emoji, is that like the official Raise logo? Like the official Raise you know how like sometimes companies take over emojis?
No, what's ours, Marvin? What's ours?
It's this one.
It's this one.
We run Navy ship. There's a Navy ship at Raise. We just do this all the time. So it's like, everywhere. Slack.
It's everywhere. And the funny thing is you know it's true because both of us did it at exactly the same time.
Yeah, exactly.
How did that happen? That does not sound like Raise, like the Raise emoji.
We have Samantha on our team just kept using it, and she represents operational efficiency. So yeah, to create a culture of operational efficiency, we just adopt that logo. We don't have to say anything, just do that emoji and then it'll get done.
Yeah,
that's great.
SAM is like the standard by which all of us believe that we can be efficient. Like if we ever wanted to be the standard, like SAM is the standard. In fact, there used to be a phrase, and I think there still is, everyone needs a SAM. Like, because SAM is just that good. She heads up our customer success. She is that good. Mm-hmm. Everyone's watching us natter as they come in.
Valuations, man, the hottest topic in this ecosystem.
The most spicy topic by far.
Spicy because everyone losing. Everyone bought a bunch of USD assets, earning revenue, and inflating currencies. No one saw this coming.
No one did. Exactly. And I think that's going to be part of like the discussion today. Is going to be so cool. We're going to like unearth all of this spiciness. It's going to be wonderful.
Big time.
Caleb's like,
No, I'm excited. I feel like there's going to be a lot of hot takes. So Dan's already got the chilies out.
Of course.
Hey, maybe we can start. With some intros and introduce the session.
Let's do that.
Introduce who we are. So everyone, welcome to Valuations 101 with our very good friends at Raise. We're going to be, we do these sessions like quite a bit now, like once a month.
Yeah.
We'll do some sort of session for founders that's focused on how do you build out your company, how do you build and launch a successful startup, how do you grow. Today's episode or session is focused on valuations, which is a pretty spicy topic, especially today. Like there's a lot happening in startup world with failed startups, overvalued startups, down rounds, a lot of reality hitting. So I'm super pumped for this session. I think it's going to be really insightful because we have like both the perspectives of like investors, operators, founders here, but then we also have like a set of methods to really think about how to value a startup methodically. So pumped for it. I might hand over to Lisa and Marvin to introduce themselves briefly, and then maybe just like a line or two on why you're excited and why this is an interesting topic.
Yeah. So, I mean, you and I are very accustomed to doing this together, and it's always such fun. And so we thought this would be a cool one to bring Marvin onto, because actually Marvin's had quite a bit of a voice in the ecosystem around valuations and how sometimes these things have failed us as startups. So we actually brought Marvin onto this session to kind of hold that space and talk about those issues from a legal perspective, because Marvin is a lawyer, shame. And also as a startup founder as well. So he has both sides. So I'm the commercial director at Raise, and have been now for almost over a year and a half. It's been an amazing ride. I am a previous startup founder myself, so I have started multiple businesses and exited them to join Raise in solving entrepreneurship issues up into Africa. And that's been amazing. So that's where we're at. And I am Marvin's right-hand human in the business, sometimes left-hand too. Just depends on the day.
Love that.
Marvin, over to you.
Yeah, thanks, Lisa and Caleb. It's nice to be here. My name is Marvin, CEO of Raise at Raise.Africa, the verb.Africa, Raise. And we provide and build and release equity software that hopefully makes lives a lot easier for founders, investors, and employees to all be financially incentivized to do the things that we need to do and the softwares that we all need to build across these verticals. And valuations is pretty critical to doing that. How we value that stuff based on when it gets built. Is it just financial metrics? Is it qualitative metrics? Like, how do we figure what that looks like? Because there is no standard, and we definitely need to figure one out soon as we can. So we work on those kind of issues. It's nice to be here.
So good. Great to have you, Marvin. I'm shocked that you used to be a lawyer. A little bit, surprised, but cool.
Just as shocked as I realized that you were actually Ethiopian.
yeah. Except except one of them is a bit worse, but yeah.
Sure, yeah, we'll take it.
I guess I'd love to know, like, guys, like, what is happening in the world of valuations? Like, where are we at as a continent? What are you guys seeing in terms of valuations here in Africa? And how does that stack up to how things should be, and maybe to the rest of the world?
Yeah,
Marvin, you can take this one.
Yeah,
no, you start.
I'll try on that one. So valuations, we said it in context, is the dollar value or the currency value that each common share of a business is meant to have. So the foundational ownership of the company is worth whatever it's worth. And that's made up of a number of factors. And those factors are dependent on global trends and local trends. And I think when we look at our ecosystem, it's clear that most of the quantitative, so the numbers work that goes into the valuation, up until recently was primarily determined by global trends, not so much local trends. And so the local trends, like our currency inflation, trade in different industries, stages, and countries across Africa, all of those things, we've at least not found a standard methodological approach to valuing companies across the African continent, taking into account the local context. And so the issue that has is all across the board. People have higher valuation caps than they probably should have, which is bad for the business as well as for the shareholders. There's employees who can't exercise stock options because the value of the company in USD has grown beyond what they could possibly afford if they make in a Nigerian naira or South African rand or Kenyan shilling rand, pretty much every currency we're dealing with. Other things it has on the balance sheet of a lot of funds. They have a lot of companies, startups that are earning revenues in Naira, but their common shares in the company is valued in dollars. So it has a lot of different like financial ripple effects and then eventually legal effects, because when companies get sold, you have to value it. And so think of it as like, if anyone's seen the market cap, so like a graph of crypto ecosystem or just the stock market in general, think of it as like the African ecosystem has a graph like that. There's been a lot of money invested into companies, but we can't see that graph because there's no way of understanding what the valuation behind those graphs are. So we have like essentially a ton of money poured into this ecosystem, but no way of valuing what it's totally worth. So if we've raised $20 billion, we have no reliable way today of understanding what the total value of that money from when it was invested to now is less or more. And I think based on what we've seen, it's probably less across the board than it was. So that 20 billion has just dropped in value. I think it's hard to say, but probably would bet. So that's what we've seen. Lisa, what we've seen on the customer side.
Can I just dig in a bit? Because I feel like there is so much value in that I want to unpack a little bit, just so it's a bit like more baby steps. Maybe for founders who don't understand valuations or don't get like all those terms. Let's start with this. Like, what is a valuation, and like why do they matter?
So a valuation is a number that you put to what a business could be worth. And that's so like, it's so vague, right? It's such a broad statement, but it's what someone is willing to sell for and what someone is willing to buy for. So in the market, if you were to take an apple and you were to say, cool, this apple, I can sell it for X amount and a buyer is willing to take that. That's what a business is going to be valued at. But again, the factors that are at play when it comes to that value is going to be what someone willing to sell for, what someone willing to buy for, what other apples have been sold for at the same amount of time and at the same size, at the same age, at the same quality. And that's effectively how you would look at it. You would say this is marketplace factors that would determine the value of this business. It's not just what I'm willing to sell for and what I'm willing to buy for. It's all the additional marketplace factors that are going to put pressure on it as well. And if I was to sell this apple only in South Africa, what would it be worth? If I were to sell this apple in Kenya or in Nigeria, where apples are really, really sought after, how much is that going to be worth? So it's taking into all of those factors of consideration, what those pressures are going to be put on, the amount that a business, in this case I was talking about apples, but in the amount of this, how are you going to be able to sell this business? What is the value that it holds?
Gotcha. Okay. Unreal. And when do startups get valued? Like at what point in the chain are startups, do they receive a valuation? Assigned one.
It's typically pre-investment, post-investment, pre-sale, pre-merger, post. So if there's a financial transaction that's happening around the equity of the business, that's when a valuation happens. When you're doing ESOPs or when you're doing employee stock options, you want to then do a valuation. So whenever there is a change in financial value of the equity of the business, that's when you want to do a valuation.
Gotcha. Yeah. Unreal.
So
Marvin's like shaking his head, like, yeah.
It's a standard process that everybody needs to go through at different stages of the company's growth. From the minute a company is born, it has a value. It's close to zero, but it does have a value. And then after that, it just meant to grow or not. And that's when you sell or dies. So all of the time.
Awesome. Great. Okay, cool. Thank you for that 101. And then just maybe one last thing. You said something about $20 billion. Was that like the amount of value that startups across Africa had at some point, Marvin?
That's how much money has been invested in cash into startups that operate across Africa since 2016 plus.
Okay, 20 billion.
20 billion plus. So it's like over 20 now. So it's close to like 22. According to Brighter and Big Deal and all these different sources. But for that one, it was just like, there's no graph of the ecosystem because it's hard to visualize that graph with words. the valuation of the
Yeah.
companies. And so, yeah, the bet there is that that 20 billion is probably reducing. And that's just because a bunch of different factors, but primarily the safest way to understand where companies stand is valuing it. And getting valuations, especially now for any founder company going out to raise or you're thinking about in the next like 6 to 8 months, a valuation doesn't happen overnight. It takes a couple of days to weeks, depending, because it's in the process. But it's definitely a part of the due diligence materials. And I think I'd even say that the ecosystem of reading an article this morning, investors are probably going to start expecting companies to at least have thought through it, even if they won't accept it, because investors will have different parameters from what the company thinks is worth, right? So
Yeah.
there's a lot of like third parties, so not investors, not founders, doing valuations specifically for African startups operating. And so everybody's basically presenting their own valuation. It's like you used to say, here's my apple. I think it's worth $2. And then you're like, well, I think that same apple is worth $3. There should be a third party who's like, actually is worth 1.5. And not just seeing
Yeah.
response based on different metrics. And
Yeah.
things like that.
Yeah. Exactly.
Awesome. Lisa, did you want to chime in on like what you're seeing as well? Like how are both founders and investors both approaching valuations? And like what is maybe some of the differences that both of them have when they approach a valuation?
Yeah. So obviously an investor's not looking at the amount of sweat equity that's been put into it. And this is where we typically find the biggest disparity between founders and investors. Is that your founder is taking into consideration a value based on sweat equity. The sleepless nights, the amount of times they've eaten baked beans on toast as opposed to gourmet meals because they put it into their businesses, the amount of months they have not taken salaries, all of the factors that founders take as valuable, investors do not see those as valuable. They're going, this is how much money I will be able to sell this business for, or my stake in this business for, in 5 years' time, once they've reached their growth objectives, right? That's the valuation methodology that's being used there. And those two things often do not ever meet. And you're getting a founder, who's discontented and probably a bit aggrieved that the investor's not seeing the amount of pain that's they've been put through to start this business. And the investor's saying, I don't really care how much pain you've been put through to start this business. You're wanting my money, and I need to know that I'm going to get that money back plus X in 5 years' time. And that's kind of where it meets. And Marvin we were at ATS at the beginning of the year, and Marvin, you had the most beautiful way of explaining it to the people in the room. Maybe you want to take people that are in this room virtually through that.
Yeah. So like we were talking about the apple, right? An investor is going to buy that apple. Apple is worth $3 USD. And then as a founder, you're presenting the apple as if it's worth $50. But that stuff that you did doesn't make the apple worth $47 more in the eyes of the person who's contributing the capital to get it back to multiples. So those multiples are critical, and they get embedded across the deal in the term sheet, because that's the point, to get to a deal of money exchange in hand. And in this ecosystem, what is particularly worrying and has been happening is the multiples on the expectations of multiples that firms, syndicates, investors, retail might have don't seem to be matching up to the exit potential of African businesses in the technology industry. Definitely for the last couple of years, and probably for a little while, because the outside multiples are just huge in dollar terms, because they get dollars a lot. Over 3/4 of the ecosystem is funded in primarily foreign investments, so hard currencies. And, as an example, that apple might be in South Africa, and the South African rand worth, what I think, like 15 rand to a dollar. But
18,
I expect a 10x multiple on the dollar, which is like a 300x multiple on the rand. And that's the actual issue we're having. Companies are not valuing them, the investors are not like figuring out what the parameters are, because no one is looking at it from an ecosystem perspective. And so everybody's doing it naturally so, and that has silos of financial information.
Can we dig
I think Yeah.
Go ahead, Lisa, add to that.
No, so just last point on adding to that is that if you're a company only operating in South Africa or only operating in Kenya or only operating in Nigeria, is that your risk is higher because you've got market factors that are applicable in that market. If you're operating in multiple markets, your risk is going to be lower because you're then, you're only exposed to, or you're exposed to a broader diversity of market factors. And that's one of the things that people are not understanding when we're doing valuations. They're like coming back with valuations going, why is this so low? Well, you're only operating in South Africa. So all of the inflationary factors, all of the risk factors, all of the, the things that other businesses are being benched against are the only ones in South Africa. If you're spreading your risk and you're going into further markets, your valuation is going to be different. But we'll dive a little bit further into that as we go.
Nice. And I guess I want to touch on one more thing before we get into the nitty gritty of how to value a company. And that's like, what is different between, say, here in the US? Because I feel like a lot of our safes are from the US, right? Like the investors a lot of the time come from the US or global. We kind of like project, I think we use the US as a benchmark for what we should be doing as a continent. But like, what things other than just currency and other than just like the idea of markets, like what things change our valuations on the continent, and then what sort of benchmarks should we be looking at on the continent?
Marvin, you're going to take this.
Sorry, did I drop?
Not at all.
We were just thinking about your really useful question for the audience of people. So, like you said, there's no secret that a lot of funding comes from American funds, syndicates, retail. It's the global VC capital. And that means a couple of things. First is that there are legally required valuations in America for MBAs and such that factor a lot into the underlying business value based on the common shares. And a lot of the 498 providers, so the people that do the third-party valuations, won't take into account as much of the local nuances of currency, of regulation, of company industries and standards and benchmarks across Africa as they probably should. A lot of it is kind of comparing companies in Africa to their American companies. And I think based on a couple of IPOs, so initial public offerings that happened of African companies, that obviously is not working the way I think we wanted it to work. So that's the first thing.
Sorry, I want to dive into that a bit because there's a lot of great language in there, but I just want to make it super like plain English. It sounds like benchmarks we use are against US companies. The value of a company in Africa is actually generally lower than the value of a company in the States, like a similar company. And we've seen that through IPOs and sales. Is that about accurate?
That's probably a valid theory. I'd want to see a lot of data around it. And I'm sure someone has done this. I haven't looked at it in a while. But probably because you have to imagine the primary function of people investing or building companies at the end of the day is to make money. Like obviously there's things we need to build, things we want to build a bit of Africa, but the people that fund and the institutions that fund businesses to build technology in Africa are primarily here for return. So the primary, like Lisa said it really well, I give you cash, how quickly and how much can you give me back? Like I give you one apple, give me like 15 apple trees.
Yes.
Yeah,
and why? Because a company at this stage in Silicon Valley can give me 15 apples.
Yeah, it can.
So why can't you?
Yeah, and then you layer on, lack of trust, rightfully so, for capital markets and how things functioned in the corporate world of Africa for the last few decades. Then you have just inherent bias against the valuation companies, and it's honestly warranted, bro, because you can't get the money back out. And even if you did, the currency issues would have decimated your money anyway. So like, there's all these legitimate reasons to price companies more realistically. But on the other side, like Lisa said, the amount of work that goes into building a seed stage company in Africa that will not be successful, and then a seed stage company in the States that is going to be successful, probably the same, if not harder, because of the just factors to deal with being on the continent, right? So I wish that would be present. I wish as well, like the development that companies, we all contribute to the development of these nations, would also be priced in, because it is in global markets.
Exactly.
So could be, but not.
Yeah.
Any points you wanted to add to that, Lisa, before we get into like how do you
No.
value a company? No?
Marvin nailed it. Marvin absolutely nailed it. Our ecosystem is developing. It's not as developed. Our market is not as developed. Our economies are not as developed. Our infrastructure is not as developed. And yet we're being priced against a developed nation. So that isn't being taken into account when it comes to the multiples that are being added. But we'll go through the multiples and how those are put forward now.
Awesome. I have one thing I might just add to that as well, just from my perspective as with the investor hat on, is like, we still haven't seen like enough. I think like global investors as well, even local investors, I don't think we've seen enough to like prove that Africa has like these massive wins. And when we think about massive wins as investors, we're thinking about these massive companies that have really returned money, like think Stripe, Airbnb, Facebook, et cetera. We haven't had a massive large scale win like that on the continent, and most of them that we have had have been less than $1 billion. Generally, investors are looking to get over $1 billion when they sell or exit out of a company. So we're kind of playing this game where it's unproven, and the narratives we're seeing lately aren't supporting that like we can actually do that, and they're not supporting that we have a strong narrative as a continent, which is unfortunate, and sort of the role we're all playing to sort of improve that narrative and support founders. But that's another thing. I think like a lot of founders like, why am I not getting a deal? It's like actually the optics of the whole continent is impacting your company.
Yeah. And it's like you're asking the Zimbabwe A team to compete in the World Cup rugby, right? That you haven't done the development, you haven't put in the time, you haven't grown the economy, you haven't grown, from school level rugby all the way up, and now you're going, cool, Zimbabwe A, you need to play against the All Blacks, or in this case, the Springboks. Okay, like let's be realistic, right? So you just, it's not fair. There's a level of fairness that's not being applied.
Yeah, and I would say, just to add on, Caleb and Lisa, like founders are absolutely at a disadvantage in this conversation. We all are, because it is the professional job of a manager of funds like you, Caleb, managing a syndicate. It is your job to return money. It is your job to think about the fund models. It's your job to think about like you constantly, not going to check it all the time when you're fundraising, obviously, but it is a top of the mind all the time. You're operating money. That's your job, right? All founders, except probably Raise and Parity and whoever builds like startup software, we almost never think about this stuff. And the only time is going to be useful evaluation, because any company on this would not watch it, look at it all the time. It's useful to do it at different milestones in the company, because it helps the people managing the company over time as it grows set different growth milestones. So when you raise a Series A, you're not just on vibes, right? Like, what does Series B look like and how fast can we get there? Pre-seed, seed, it's less, fun.
Raise on vibes. I love this.
You don't want to raise on.
Do I trust him?
Yeah, exactly. Pre-seed, seed is like, can you actually execute? We're still developing the industry stage country groupings to pattern match, right? We probably experience this all the time. And otherwise, it's just like, we're valuing, like I remember when we set our valuation cap in 2021 when everyone was raising, it was genuinely based on benchmark. There's a bunch of other people raising at these valuations. It was like, what is 50% lower than that? Because this doesn't seem sustainable. And the value like held consistent value over time, versus we've seen a lot of safes obviously get decimated in value, right? And that has it's the founders at a disadvantage, but it creates a disadvantage, Caleb, for you and syndicates and other ones, because you lost money to no fault of your own. You're just trying to invest in companies, So valuations help solve a lot of that. They could.
Yeah, they could.
Yeah. This is too much fun. I feel like we could talk about this macro valuations thing for ages, but we have some practical, hard ways to value companies. So Lisa, would love you to show us like, how do we value our companies? What is
Absolutely. So back end team, won't you let me share my screen, and then I can go through some of this with you, because this is going to be an interesting thing. So I'm going to take you through Futureproof. So Futureproof is a business that I started with two other co-founders. We started the business 8 years ago, but we incorporated the business 5 years ago. So it was a passion project, and now we've done this. So we're in the process of selling the business, and so I didn't like I was kind of umming and ahhing about it. And so I actually, when we added valuations as a formal service in Raise, I was like, cool. Well, we use Futureproof as the guinea pig. We always use Futureproof as the guinea pig for equity clinics, for whatever we use Futureproof as the guinea pig. So Ozzy, won't you let me share my screen so that everyone can see it? And so I'm going to actually take you through the different methodologies that are applied in this valuation. And I'm going to explain them to you, but I'm also going to use our report as the example of how they are applied. So the last one that we did financial modeling with you. You put all your cash expenses and income on the table for us to model out. So I thought it would only be fair that I put like what happens in the Futureproof kitchen on the table and take everyone through this so that you can see, you know, what it actually looks like in reality. All right, so what happens on Tech Safari webinars stays on Tech Safari webinars, just saying.
And stay online.
Yeah, we all know that's not true. Okay, so this is Futureproof. So just as a backstory, Futureproof is entrepreneurship education at school level. Okay, so what should we have learned at school as entrepreneurs so that we don't make massive fuck ups later on in our businesses when the risk is so high? So we should be learning this at school. Yes. No, every entrepreneur in the room is going, can someone please get this into schools? That's our job. Okay, so we're going to run through this quite quickly so that you guys understand more the methodologies as opposed to just the report. But effectively, what we want to have a look at is the 5 different ways in which businesses can be valued and why an approach to looking at the 5 different methods as weighted methods for the stage of business that you're in is probably the most fair way of valuing a business. Okay, so this is all blurb, blah, 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 blah. This is where you want to start. Okay, so there are 5 different methodologies used in valuations. It can be a scorecard methodology, and I'm going to explain all of these. Scorecard methodology, checklist methodology, venture capital methodologies, DCFs with LTGs. I know, like, everyone's going, oh my God, please can we not use acronyms? So DCFs is discounted cash flows. LTGs is with long-term growth. The DCFs is probably the most standard methodology that's used in for valuations. It's great for later stage businesses. It's not great for early stage businesses where you might not have generated a lot of cash in the business, and therefore you can't work with this methodology as much as you can with the others. And I'm going to explain this. So DCFs with long-term growth, or DCFs with multiples. So if you were to sell the business, what would that cash look like with a multiple that's added on top of it? And it's usually a benchmarked multiple for the industry, for the country that you are working in or operating in. So those are the 5 methodologies that I'm going to look at quickly. What this valuation kind of dashboard gives you is a low bound number. So this is like the minimum number that you should be looking at, and a high bound number or the range. And then kind of in the middle is where you would peg yourself. And this is an amazing tool for founders to go, cool, this is the range within which I can probably negotiate if I'm looking for investment or sale. So this is the nice part about this, is there's a range within which you can work, depending on your stage of business. I'm not looking at the questions. So if someone else is looking at the questions and something interesting comes up, let me know. All right. So This is how they are weighted. Okay. So 15%, because of my stage of business, it's an established business, but it's still considered a startup. So we're not in growth stage yet. We're a single operational market in South Africa. And so this is the weighting that's applied for a business at this stage. So 15% to the scorecard method, 15% to the checklist method, 16% to the venture capital method, 27% to DCFs with long-term growth, 27% to DCFs with multiples. We are post-revenue and we're past break even. So we're at profit making stage. All right. Except we were pre-COVID. So this was interesting. If your valuation is being done now, you've got 2 years worth of financials that are being taken into account when looking at your cash flows. If those are COVID years, expect lower valuations, right? Especially if you were affected by COVID, which our business, because it's education, was affected. Questions at this stage, Caleb?
My only question is like, I bet everyone is thinking, wow, this is really well put out. Like, how did they get access to this? Because I kind of want to
how did they get access to what?
So like to an analysis like this. This is like the raised valuations.
Yes,
Is this
and powered by Equidam. Yeah.
Yeah, nice. Okay, cool. Good to know.
Yep.
So we'll share links on how you can get this later.
Definitely. Yeah. I mean, the team can actually pop it into the chat now. So qualitative methods. Okay, so this is looking at qualitatively in the business. What have you built inside the business? Okay, so this is taking into account some of the things that founders have put together in the business. It might not be reflected in the market because the market conditions are not conducive to growth, but it still doesn't discount the amount of work that's gone into building this business. So like the team, how you've protected your IP, what strategic relationships do you have? How much funding do you need to make this business sustainable? So can it wipe its own face? So this is a qualitative method, then takes a deeper dive into the structuring of the business and actually gives credence and a weighting to the build of the business from the inside. Okay. Questions or comments around this? Yes, I thought you might. Yeah.
So Lindsay's asking how you decided on the weighting mechanisms.
Okay, so I'm going to get to that at the end.
Oh, okay, cool.
Lindsay, yeah.
My extension to that was like, is this personally just based on the investor? Like who's in the driver's or like the assessment seat when they go through this?
So this is independent, right? So what's nice about an external valuation is it's not the founders supplying the financials, which have to be verified by our internal analyst. She verifies them first before they go through the exercise. So it's the financial forecasting that we did in the previous session, that's included in this. So people will actually go through an exercise where the finances are actually just stress tested to see whether they actually hold up and if the assumptions are correct, and then they get inputted into the methodologies. All right. So it's not a driver of an investor standing here going, okay, well, I want the lowest valuation, or a founder standing here going, I want the highest valuation. It's an independent analysis of it, which is why it holds more weight or credibility. So I can with confidence put this in front of an investor or a buyer and go, this is fair, right? So qualitative methods. Cool. This is how the qualitative methods work. This is the other qualitative method, and this is a checklist method. So very similar to the scorecarding method. You want to look at the quality of the team. You want to look at the quality of the idea. You want to see how it's been rolled out. What are the strategic relationships? What is the operating stage? And this is benched against the other businesses similarly operating in your field, right? So this is the topmost sort of tier or kind of cap on it, and this is where you feature in terms of the other businesses that are benched in this market. So for us, it's online, hybrid, supplementary educational products to schooling, and they would then bench against those, right? So these are the two methodologies that are taking into account how has the founder built the business, and is it strong and sturdy from the inside out, which I think is actually really important when it comes to valuing a business. You can't just take, particularly with COVID, taking your cash flows when we've had a world anomaly that's caused market pressure. So these methodologies, I think, add a nice balance into it. Okay.
And I might just add, like, just like from the investor perspective here too, I think a lot of what we invest in at the seed and pre-seed stage is also like market and founder. Like those things are actually quite important, not just straight revenue. Because if you have like a big market, like sometimes it takes a long time for that to be worthwhile, like for what you're building to actually add value or to integrate. If you're betting on a good founder, you're betting on that team winning in some way or another.
Right.
And ultimately,
And
like,
when there hasn't been, dissolution of the IP outside the founder and the management team, you want to know that that is solid.
yeah, big time. Yeah, and I think like VCs also bet on people before like just companies as well. So there's a trust factor there too. So I feel like I would take like a higher val if I really think the founder can do it, and they've a track record or they've shown that they can do it. So
absolutely, this is just the breakdown kind of what that looks like. So what does this business look like? Really, I'm showing you in the kitchen here. Okay, so VC method, this one's a little bit more complicated. So it's eventually saying like, this is kind of benched standards. They're taking an EBITDA multiple thereof. So your net profit pre-tax, and they're taking a multiple of that. Then looking at the required return on investment. Okay, so you're saying, cool, this is the multiple of your EBITDA. So there's a multiples added, a benched multiples added. In this case, it was 18.25 because that's the expected growth of this industry, EdTech specifically. So this is it added to it. And then this is the annual required return on investment. So now you're looking at your cash flows and you're saying, with your cash flows, can you meet the required return on investment? And if you look at this, because we came out of COVID, with the multiple attached to it, Futureproof is really going to struggle to do that. Really, really going to struggle to do that. If we had investment into the business at this stage with that multiple added to it, and this is why you have to be really careful what you bench against, because if that multiple is unrealistic for the market that you're operating in, you're setting yourself up for failure here. So am I then able to, as a business, deliver the value back to the investors that have now invested into the business? And based on the growth of the business, particularly coming out of COVID, I would not have been able to do that in this business, right? That's why you're seeing this valuation.
I mean, here, like EBITDA, this feels like a bit more of a later stage metric, right? Like, if you're investing in an early stage founder, I feel like this is more either traditional business or it's like more like when you're actually a lot bigger, not VC. Like which sort of investors would use this and at what stage?
Your growth stage businesses. So your scaling stage businesses are going to use this. Marvin, I think you guys are able to speak more to this since you've been through this kind of agreements and term sheets.
I was just gonna say, I was pulling up the other part of the report that you're pulling up that shows the comparison of companies. Because I remember for Raise, we did one of these ones that you showed much earlier on in like the pre-seed stage. And then we did the one recently after Equifax did the valuation benchmarks, and that one was a lot more tactical and helpful and useful at the stage we are because we're trying to benchmark ourselves against other SaaS B2B companies. So that's all I just wanted to add. I'll put it up. I could show it after.
Cool. Now we get into DCFs. This is the one that everyone kind of rolls their eyes at because DCFs are okay.
DCF
so let me go
LTG. Like, what does that even mean?
So let's discuss this like in its entirety. So DCF is discounted cash flows. So it's to say your cash that your business is earning currently. Okay, and let's all agree that, let's take our Apple analogy, that an apple and what it's worth today is not going to be the same price as what it's worth in 5 years' time because of inflation. So because of all of the things that happen, is that your buying power today is less than your buying power in the future. Okay. We can all agree that that's the case. So what is your cash going to be worth in the future? So what is the cash that your business is earning going to be worth in 2, 3, 4, 5 years time, right? And that's why this is discounted cash flows. So the cash value that your cash holds in 3, 4, 5 years time with long-term growth. So if you were to grow this business over the next 8 to 10 years, what is that cash going to be worth then if you maintained the same amount of traction? No like massive exponential growth. If you just earned what you're earning now for 5 to 10 years time, maybe with a 10% increase based on inflation or whatever it is, what would that cash be worth in the long term? Okay, right? So they're basically taking your income or your turnover now and saying, cool, in 5 years time with all the inflationary pressures, what is your cash worth then with growth? Okay.
Which
is everyone,
sort of
you,
I follow. I mean, yeah, if you wanted to add to that, continue, but I had a couple of questions about.
No, go for it, ask.
So which sort of investors would use this, and then why this method? Like why is this method an important one?
Well, someone's putting money into your business, right? So they're saying, cool, what's my money if I put in now going to be worth in 5 or 10 years time with the current growth rate of this business? Okay. So you can speculate as an investor and say, cool, if I put this money in and if the founder tells a great story, cool, it's going to be worth 10x this. Yay, great. But currently, if this is what the business is turning over and predicting to grow at, if I put money into this current state of this business, what would it look like with long-term growth?
Okay.
Okay. You're pulling a confused face.
No, sorry. No, I get it. But like, who would use that? Because that's definitely, this is not. I mean, I've seen some VCs do this, but like, this is definitely not seed or pre-seed stage. Yeah.
No, angel investors might do this, right? So you got an
Seriously?
angel investor who's coming in, who's saying, "Cool, I'm in this for the long haul. I'm going to be here with you for long-term growth. If I put this money into this business at this stage, what does that look like?"
Okay.
So that might happen.
Is this a startup? Is this like, do startups use this much though, or is that more traditional business? Because I haven't.
Startups do use this. Well, startups that are post-revenue.
Yeah.
So, and I would say 2, 3, 4, 5 years post-revenue. So you've already done revenue. You break even. You're in that stage of market growth, and you potentially want to expand.
Yeah.
You can use this method.
Cool.
Okay,
cool. Because again, I haven't seen or like thought to apply this method, and I think having like expectations on revenue like that for a startup that's supposed to be very high growth doesn't feel like a fit.
You might land yourself into hot water. Yeah, exactly.
Yeah.
Okay, DCFs with multiples, right? So this is multiples that are applied. Industry benchmark standards, multiples. So if multiples is assuming exit, okay, so you're going to do discounted cash flows assuming an exit. And in this case, it's assuming an exit in 2026, right? That's where you can see it. So it's saying, cool, your cash flow with all of the inflationary pressures and market pressures and everything that's being put on it, your money's not going to be worth today what it would be worth in 6 years' time or 3 years' time. But then someone would exit based on a multiple. And what would that multiple be applied to the cash that's being generated by the business? Okay, so it's still DCFs, discounted cash flows, but it's now saying on exit, you would apply a multiple. What would that multiple be against market standard, against the cash flows? This is what you would get out of this business.
Nice. Okay, cool. Okay. Whereas the previous one was just on cash flow.
And long-term growth of that cash flow.
Right, okay. Okay, gotcha.
Yeah, okay. Right, so this is what's being
Can I ask like a broader question?
Sure.
A broader question that comes to mind is like, what is like these methods? So a handful of them seem like very clear, like startup, you see it all the time, pre-seed, seed. And then a handful of these is like very like DCF, again, like seems very later stage, very PE and like not applied, almost like out of this world for VCs in the pre-seed stage, I'd say. What's the value of putting these next to each other for a founder that maybe is early on their journey?
Say that again.
what's the value in putting all of these valuation methods next to each other for a founder that's like
Right.
maybe early in the journey or later? Like, what can they learn from say DCFs or from like
Yeah, so I mean, if you're going to be a line item on someone's fund, you have to understand that you have to generate cash at a multiple in order to meet the investor expectations. Because they're looking at your scorecard and their checklist and they're going, that's fine and well, but we have to have a return on value, right? So if you're looking for investment from VCs, you need to understand this is how they're looking at the valuation of your business. Yes, they're going to say, cool, can this person deliver on the promises that they make? But those promises have to match discounted cash flows.
Yeah.
And you're saying pre-seed, it's not necessarily pre-revenue. We might be a pre-seed business, but we're post-revenue. Right?
Yeah.
So you're applying this to a stage of growth of a business, not necessarily as a funding stage of a business.
Yeah, for sure.
Okay, and that's why I want to show you this last thing, right? So this is the last little bits that you want to understand. Where is it? In terms of the application of it, this is all cash flow, legal notes. Oh, here we go. Here's the methodologies, and this is what we were being asked earlier. Lindsay, this is what you were asking, right? Okay, so this is what is being applied, and these 5 different methodologies at what weighting. And this is what you're saying is that here, 38% is checklist when you're at idea stage, 30% being at development stage, you're still going to market, you're still understanding this. Startup stage is where we were at. And that's why it's 15%, 16, 27, 27. And when you're at growth stage or expansion stage, this is less because less is dependent on the internal team. You've done your product market fit. It's been proven. That's why your discounted cash flows are now higher weighting.
Gotcha.
Okay. And this is kind of where the fairness comes in.
Yeah.
Of this.
Yeah.
Marvin, you've got comments, I'm sure.
No.
Super clear. I had a question though. Kelly, how do you run valuations for companies you invest in? What do you look at?
How
do you run it?
Very basically, obviously. I think like the way that, and sorry, I really like that because I think that was kind of to my point before, Lisa. Like, if all of them are weighted the same at an idea stage, I think that's like a bit that's a lot, right? Like for a startup that maybe is pre-revenue or like
Zimbabwe A playing the Springboks.
Exactly, I love that analogy. And I think like I like that the weighting is all different. The way I think about it is definitely not like as in depth as this, but I do like this way of thinking. I think as like a pre-seed and a seed stage investor, I think a lot about how does a company unlock the next stage of funding. And to me, those are usually like Series A benchmarks. And in Africa as well, maybe the context, I've written a piece on this, is like Series A is like the round of death. Like compared to all the other, compared to like the US, like it is so much harder to raise the Series A here than it is in the States, just because like it's harder to build a company here, but also like valuations are different. The benchmarks are so different. Actually getting capital like that is quite hard. So I think that's what I think about is like, what does this company need to do? Do we see like a clear path to a Series A for them? That's really where we support the most as well. So I'm generally thinking about like, what is their valuation in comparison to what they'll get at that stage, and how much revenue like can they unlock in that period? It's a bit different. Yeah.
So I want to say something at this point. Looking at Futureproof's valuation, it's at $1.4 million, right? Okay. And when Marvin saw that, he was like, okay, Lise, maybe like in a couple of years you'll do it and you'll get a higher valuation and the COVID and this and that and like whatever. And I'm looking at that and going, that's 26 million Rand, right? Okay. I know that going to market with a 26 million Rand valuation on Futureproof is probably a little bit high, right?
Yeah.
Okay. So So in terms of like where you work within that range that is there on paper. And that's why there is a range that's there, is so that it gives you and the investor or the buyer the peace of mind to say, this is where you can start negotiations and this is where the fairness still applies to this.
Mm.
And you can both have the peace of mind to know that there is a peg somewhere in there that you can both land on.
Yeah, big time. That's awesome. I really like that it's not a hard and fast. It's like it is a range, and it's something you both settle on as well.
Yeah.
It's a negotiation for a portfolio. And Caleb,
Yes.
the way you invest is the way any professional investor or manager of money would invest. And in that calculation, essentially looking at the next round with metrics that I'm not sure we actually have for this ecosystem, like industry and stage, like fintech B2C company kind of knows what they have to hit, but based on what other people have said, not some third party verifier. Right? So what's missing in that context of that valuation next round is all of that stuff Lisa just took us to. The inflation, the stock market of South Africa affects the valuation of that company, like all of the things in that bucket of things are missing. And equity does a phenomenal job of capturing all of that stuff. And then what we work with them on, and the team does, is improving it, the parameters. So for example, I know Chinyini on the call over the last couple of weeks has downloaded something like tons of Excel sheets I just saw from like 30 African countries and like 18 stock exchanges and stuff like that. And just measure the multiples. Like if you got a 1.4 on Equidam, that can't be a 56 million rand, but what would it look like if you were trying to sell to a local purchaser? But what would it look like if you were trying to sell that same company denominated in USD and to a Nigerian education tech company, right? They'd probably be from a perspective of narrow, right? So all of those different nuances we try and help them build in, hopefully successfully done. And all of that makes for a fair valuation. So you don't, and other investors and users don't have to just look at the next round, which is the markup, which is the distribution of profits, which is your job. So looking a bit more holistically at like a funnel of companies and their valuation as it may or may not grow over time, but realistically what you can exit where based on the market, not just the next round. I think that doesn't seem to be working as much.
Exactly.
The latest data from Q3 is showing a huge drop off in Series A and Series B companies because of the inflated valuations in 2021 are kind of showing the heads now for a lot of companies, not everybody, but it kind of exposed the companies and people who are not looking so much as liquidity and cash flow metrics, which is hard to look at early stage, but I feel like it's a bit of a return to the fundamentals of looking at that stuff. So for example, for us, what we try and do in Equidam and the customers and partners we work with is trying to figure out, okay, that trend is happening. How do we adjust the parameters and stuff Lisa showed us in such a way that it creates more fair valuations and gives a space for companies to actually grow within the market and currency and political limitations that we all have. And that's what I was asking about how you invest. Lisa, what are you thinking?
I'm actually thinking
just around
to open it up.
Before you go, Lisa, I want to say if anyone has questions from this,
it's exactly what I was going to say.
Oh, great. Okay. If anyone has questions from this, put them in the chat. I would love to. We have some really interesting comments here that I'll read out in a sec. Were you going to add anything else, Lisa, or is that your?
No, I was going to say I wanted to ask some questions to the audience and to say like either questions on what we've shown you or questions or advice. Maybe you want to get some advice on how evaluations should be done. And then at this juncture to say that we would really like to offer anyone on this webinar with us 10% off of your valuations. We usually charge $150 for valuations. We're going to be charging $135 for valuations, and that's a special offer. We always have Tech Safari offers going out because you guys are amazing partners with us. And you'll have the expertise of like our corporate finance analyst looking at how to value your company, and they take you through an onboarding chat, and they'll capture all your information really easily and really quickly. They'll go through your financials, they'll ask you whatever questions they need on the assumptions, and then they'll walk you through the valuation at the end of it on a call with yourself and other founders or other members of your team, to actually take you through it step by step and show you how to apply a valuation when you're doing your next round, when you're going to sell, when you're ready to raise.
So good. I'm trying to grab the. Ozzy, do you mind just sending the link? It's not loading.
Yeah, she popped it in now.
Nice. Great. Okay.
So it's in the chat if you want to access that.
So there was one question here. So personal valuation of the company also counts in company valuation, not only market-based factors.
I'm not sure. I don't think so. No. I can arrive at the market with my gold apple and tell you it's a gold apple and tell you that you need to pay more for it because it's a gold apple. But if you're just looking for an apple, you're going to pay apple prices. So my opinion of a personal valuation to the business and how much time and effort I put into building this business, unfortunately, it only counts towards scorecard and checklist method if it results in the build of the business and structure of the business being solid.
Yeah.
But I think this is one of the things that founders really struggle with, is being busy is not being productive. So being busy building your business doesn't necessarily mean you are productive in building your business. So doing the things that matter, knowing what matters, and doing those things in order to result in value added to the business. Yeah.
Love that. Yeah, like I think personal feelings, etc., don't matter. Like what generally matters is like progress, which is generally like revenue, traction, relationships, however you want to quantify it, whatever your metric is.
Yes, exactly. And that's why all of these methodologies put together give you the fair view, as opposed to the single point of view, which is heavily weighted with bias on both sides, investor and startup founder.
Yeah. I might just ask everyone in the chat, everyone who's like viewing, we're going to wrap up in a minute. But what's one thing you took away from this session? Like what's one learning you had? Put it in the chat and we'll read it out. I'd love to know. So I feel like there was so much in there at a lot of levels. And there was also like a lot of, whoa, like I just learned this and like, on my side at least. So I think it'd be really cool to hear what everyone else found interesting.
I love Olamiji's comments here. The value of stacking these methodologies side by side is to help the founder have a clear idea of what investors are interested in and what the business is in terms of the true value of the company and how it will guarantee the best ROI. That's amazing. Like that just sums up the entire hour in one statement. Very cool. Very, very cool. Thanks, Olamiji. And you're one of our biggest fans. You always come to these, so that's very cool to see you back. Nice. And then do we want to just talk about, well, people are putting that in there, what's happening at the end of November in Cape Town? Just a little teaser, just a little teaser.
So for anyone here in Cape Town, we are doing an in-person event. So our very first one together with Raise. And a few awesome like other companies in Cape Town. So if you're in Cape Town, keep an eye out, keep your eyes peeled. I think maybe next week we'll launch it. I'm a little bit worried because like I did it, we launched Nairobi and it filled out in like a day, actually in like a few hours. So, which is why I'm a bit scared.
We're just letting people know. We're just letting them know. We're just putting it on the radar.
The only way to get to be early is to be subscribed to Tech Safari. So make sure that you're subscribed. It's techsafari.io.
And Marvin's going to be there and I'm going to be there.
Yes, you'll get to meet the whole gang.
Yes, exactly. We'll try and behave ourselves. No, we won't.
Absolutely not.
Absolutely not. Well, Caleb's like, no, that's not happening.
Not allowed.
Lindsay's message just as we end. There's a really good way to end this talk. Like we talked about like tactical ways to get valuations, why they matter, what they look like, all that stuff. And but there's still this like lingering ecosystem issue, like the same where is a bit of a science and an art. I would say it's probably neither, but it probably should just be a science, you know? So it's like we have a long way to go to where we just quantify just because the African economy can't absorb as many startup failures of high valuations of dollar companies, you know?
Yeah.
Like making it more of a science and this that data-driven stuff that Lisa was looking at is critical to help companies and founders and investors make better deals, but it's also like an ecosystem imperative. And so, you know, hoping Lindsay like kind of summarized it really well. Thank you, Lindsay. Hope Lindsay
Thank you,
That was
Lindsay.
great. It was really good.
Amazing.
Cool. Nice. Should we wrap that?
I think we should. Mic drop. Marvin, do you want to
Mic
show your superhero stance?
Jazz hands.
No jazz
Jazz hands.
hands. That's jazz hands light. Show us your proper your superhero move. Yes.
We did a deal.
Exactly.
Yeah, that's
Love it. Guys, thank you so much. I can't wait for the next.
Yes. See you in Cape Town, everybody. Can't wait.
Yeah. Awesome.
Yes. Catch you guys then.
Thanks. All right, see ya.
All right. Thanks, everyone. Bye. Glenn's still struggling. Ozzy, why don't you just pop the